private equity, property, real estate, there's a whole mixed bag of treats in here, a lot of different sectors. Let's talk about macro trends impacting 2026, coming off of the back of, I guess, probably what was a lot of rate movement, came off the back of inflation, then we had a rate curve has been changing. So where do we think the trends are going to be for 2026, Tony?
So a few different trends that are going to really make an impact. I think one is demographics. So when we think about the fact that we are kind of 2 years into a 14-year super cycle of people turning the age of 75, you can't help but look at the retirement sector. And so we have a few different types of asset classes in there. You got retirement, you got land lease, you got aged care. So that'll be interesting. And you're actually seeing a lot happening right now over the last 6 months. And I think you'll see more happening next year, where both institutional capital that's onshore as well as offshore is taking a good hard look at all of those sectors.
Yeah.
I think other things when you think macro political environment all over the world, there's a lot of different moving parts that are happening in a lot of different places. And what that oftentimes does do is shed the spotlight on Australia into the relative stability. Now, the market in Australia is not as deep as some of the other markets in Asia, particularly Japan, Korea. So that's one of the frustrations sometimes for large private equity firms that are trying to get deployed. You know, they don't want to put 100 million, they want to put 500 million or a billion. And there just aren't as many opportunities to do that. But when those opportunities arise, I think there's definitely a lot of capital that is around to look at that.
Now, can I hit pause on that for 2 seconds? Because I think there's a couple things on even just sort of the living sectors for macro trends in real estate. But you've been involved in some pretty big M&A transactions lately. And I think we're probably going to see a bit more of that, particularly from that offshore capital coming through.
Absolutely.
Yep. And then would you also, like, where would you put, say, I think we're back to demographics a little bit here, migration, student population, we know how much of an impact that is on Australia as well. I think the 23-24 figures were like a $50 billion contributor.
Yep.
So where does that sit in your world as well for a macro?
So absolutely, the turning on again of the students that are coming in, which was on pause over COVID, we're seeing a lot of that. So I think that will continue, and I think that, you know, interestingly enough, education is probably one of the largest exports that Australia has that you don't dig out of the ground. I think, in fact, behind metals and mining, it is the largest export. So I think that PBSA as a sector, you know, other end of the sector and spectrum, the purpose-built student accommodation will be something where you're going to see a lot of groups trying to get set over the next few years. Another one, when you're talking asset classes, which again is driven by the macro when we're looking at affordability in the living sector, I think build to rent is an area that it is fascinating. Capital is circulating because build to rent, or multifamily as we call it in the US, is a sector that is super mature in other parts of the world, and it is not mature yet here in Australia. There are reasons, there are structural reasons behind that, particularly around taxes and things of that nature. And so it's a nascent sector here, but it is growing. And it's, interestingly enough, capital wants it to grow faster than it is growing. So there are a lot of particularly overseas capital shops that are here that are trying to get set and trying to breathe life into the BTR sector. And it's just taking longer than they would want for that to happen.
Yeah, and I think we're seeing that as well on a lot of the product that we're representing, whether it's part of what we see as sort of the new supply paradigm that's coming out of Sydney through the LMR reform or the TOD reform or HDA specifically in Sydney, and a number of new sort of advanced planning pathways that can help to increase that supply more quickly. We all want the stock. We're sort of at a bit of a misstep for lining it all up because we have come off of the back of a pretty intense rate change environment. And up until a few months ago, we were probably staring down the barrel of a shallower, sloping, longer downward trend in rates. And that's not the case now. Now, I think there's probably a double-edged sword to that in so much as that you can probably stabilize prospectus to underwrite to help match what's happening in the inflation space, particularly around the cost of development. But also, I think it's going to create a bit of confusion too around where does the real supply of high quality stock come from?
Part of what we do is we partner with developers. So I've got apartments coming out of the ground. I got apartments in all stages right now for our developments. And your point about the planning is a great one, in conjunction with rates. So just from that, put the pin in the macro side of the house, I actually don't think rates are going to be going down a lot more. And that's coming from a long record of looking at rates and understanding it. I think that people who think rates are going down again have got it wrong. I believe that we are, as much as I would love for it to be the case, I think we're looking at stabilized rates. So you sit here in this long stabilized rates, but housing, it is in crisis in New South Wales. It's in crisis all over Australia. What the New South Wales government has done, exactly as you named, right? That TODs, the transport-oriented developments, and the low to mid-rise developments, coupled with the new planning pathways, have really given, hopefully, some life into developments that will take place. Now, but when you start to do a closer look at it, it's actually quite interesting. Because the other side of the coin, which you already touched base on, is the cost side of it, right? And when we look at the spike in costs to build, it means as a developer, to get developments to stack up, I need to get a certain level of gross revenues, and that is hard to get anywhere west of Ryde, right? So you're looking at a lot of developments in North Shore, eastern suburbs, sure, they stack up. It's becoming a more crowded market. So you're seeing a lot of developers that were doing stuff out west are trying to move east. And then if you want really interesting kind of proof in the pudding, you look at the TOD. So the TOD has been around for a year and a half, okay? And now look at those that have actually been approved. Something like 80 to 90% of them are along the North Shore line, not along the Western line.
Correct, yeah.
There's a reason for that, and that is that the gross revenues stack up in Killara and Linfield and Roseville, and they don't further out west.
Yeah.
And that's a problem, right? Sure, it's great that we're going to get some new stock there. That's a wonderful thing. But the reality is we need a lot more new stock, particularly out west.
Yeah.
And if the folks there can't afford to develop, if developers aren't going to take the risk of development and sales risk for the proper return, then how are we going to get that there? And I think government will have to take a forward step into helping to make that happen.
Yeah, absolutely. And I think if we talk about like other sort of potentially domestic and very New South Wales focused macro trends, we look at the new Western Sydney airport, which is being built. And I think if we sort of want to say where there are going to be opportunities, we acknowledge that in the development space, the residential supply is constrained, and it works in markets where the metrics sort of support that risk. But for Western Sydney, there's still going to be a lot of opportunity across new metro corridors, new motorways. Parramatta has a hole in it that's a couple acres.
New cities,
Bradfield. So this Western Sydney airport takes off, pun intended, in 2026. And that's going to be at a cost of about $6 billion. Do you see much, where do you see, I guess, private equity or private capital or that non-bank space taking a position in something that is ultimately a greenfield market, but still is driven by that fundamental federal infrastructure investment piece of $6 billion?
Absolutely. So I think, Mark, that the first thing will happen is you look at the airport precincts as they've carved them up, and when they get a good chunk of something, whether that be industrial, whether that be the markets that they're meant to move out there will be some first mover critical infrastructure that will do well. So if you look at the land that's adjacent to the airport, there have been people looking at building data centers out there. There have been industrial sheds that have been planned for a while. There are groups that have made commitments on the land. And then I think the question you were asking is, when you think about the private capital space that will be supporting this from a debt perspective, they're going to want to be looking for backers that have really the prime position for whatever it is that they're doing, right? Data centers don't need to be, they need to be near services, but they don't need to necessarily be near the airport or near any particular place. So sometimes you can fit them in interesting places that might not otherwise be good for, say, industrial, because you don't have the vehicles coming and going all the time. So I think that capital, you look at the township or town of Bradfield, an entire new town that's going to be built. Now, if you look at some of the new towns that have been built in Australia, look at Springfield, up in Queensland. That's been an evolution over 20 years. And yes, capital has done well, but sometimes it's taken a long time for it to go. So I think that some of this capital that's coming here is going to want to find stuff that's going to be built and operating soon, and that they know is going to be the best bet.
Yeah.
And in my opinion, that'll start with more industrial type of capital than resi. Once you get that core of a city happening. Another place that's quite interesting, you look at Oran Park. So Oran Park, and that's an amazing development that Parages have kind of built. They've got resi, they're really focusing on the town center right now. And I think that the capital will follow where they see, a business case for something to stand up and work.
Yeah. Two things that I pick up from this conversation, Tony, and I know you guys have a number of business lines to your banner. You've got your funds management, you have consultancy, insolvency, restructuring. I think from our perspective, there's probably two things that jump out to me if I were to forward into 2026 and say, what am I looking for? Where is value in this? And I think you've touched on it in so much as it's a return to the fundamentals, right? There is a lot of money at play in circulation. We have an established capital market system in Australia.
Yeah.
But notwithstanding that, people are still looking for value, and we're looking for security. And I think the rate change that we've been involved in lately has really shown that there are some cracks, not just in systems, but in sectors as well. So then if I go to the second point and I say, for me, transactionally, where I'm involved and where I'm seeing the most amount of velocity behind that liquidity profile is really going to be in sort of that alternative space. So you talked a little bit about data centers, a lot in living sectors as well, I think, is what we should be positioning ourselves for in that value chain. And Australia has a lot to gain from diversifying its housing supply in particular to seniors, aged care, low care, high care, student co-living, and what have you. So I think for my vision, 2026 is about, and we hear it a lot, people saying back to fundamentals, but it's really real, right? And it's going to be focusing sort of on the edges of these asset classes that we've been talking about for a long time, which are now being able to physically manifest by way of reform, either in the planning side that we see here in New South Wales in particular, or because of some of these, fortunately, that we've been having long-running investments like an airport that can support advanced manufacturing, can support jobs that are human capital intensive to create that ecosystem around inbound student populations as well.
Yeah.
So those would be my thoughts on where I see 2026.
Yep.
And for you, where would you put the forward-thinking piece?
So Australia is a market of micro markets, right? There's no doubt what is happening in Sydney in office is different than what is happening in Melbourne in office or Perth in office. And I think that office, which has been, a risk-off kind of for a long time, there are folks that are starting to wade back into that, and particularly private money that is looking over a generational time frame. So they're happy to say, you know what, this is a time when I'm able to buy that's relatively unique. They maybe don't have the drivers of the short-term returns that some of the institutional capital has, but even Insto is starting to look back. Right now, everything that I hear is that Sydney is what they want first before Melbourne, but you're starting to see some movement there. I agree with you that alternatives, are interesting. They are becoming more mainstream. Now, one of the interesting things with alternatives, and a lot of the professional money does get this, they're operating businesses, right? So people, were like, oh, okay, let's go look at this retirement stuff. Yeah, our returns are much higher, but it's very different than having an office tower or a shed where you've got a 10-year lease or a 20-year lease. It is an operating business that's really important, and the professional capital understands that. Yeah. So I agree with you that I think alternatives is a place where you'll find some value, particularly with the tailwinds of the demographic tsunami, which are kind of at two ends, right? You've got that retirement, and you do have that younger cohort that's looking at both the purpose-built student, as well as the co-living, which I heard a term the other day. Co-living is actually simply studio BTR. It's built to rent for studios as opposed to proper apartments, which some BTR people don't like that, or co-living people, but it is interesting. That is what it is. And they're targeting those kind of both students and young 20-year-olds. So interestingly enough, co-living, I was speaking to a couple of operators of co-living buildings, and they actually put their own cap on they won't have more than 40% students in there, because they don't want it to be simply a student housing, reality. So I think some of those areas, I think industrial, there's pockets of industrial that'll have some time to run, but industrial's had a pretty good run for a while. I think that your two sectors that you're going to see really up and coming is living, and living, across all the spectrums, as well as I think that office will get some tailwinds in the coming year, which nothing soon and nothing crazy, but my capital, I can tell you my capital right now is deployed across the living sector. We do like a subset of industrial, which is kind of open plan, where you get a fair bit more hard stand on industrial, and those are really the areas that I'm most bullish on.
Yeah. And if we were to talk about other private capital, private credit, private equity, the clients that Knight Frank works with sit across the debt or equity or direct invest space. And we are still seeing that some of the family offices haven't quite gotten back to an equal spread of the debt and equity positions, and a lot of changing thesis still around, do we want to get behind that, or do we want to get involved in it?
Great question, Mark. And I actually just raised more than 100 million of capital, and I was flabbergasted at the smallness of the gap, the narrowness of the gap between Big Four and private credit. Wow. It is a good time to be a borrower right now. Yeah. If you've got a solid project in a great area, and there's different ways, yes, it is still cheaper to go with Big Four banks, but you might choose speed if you want to start a project without your pre-sales, where you'll have a little bit more leeway with the private credit than you will with the Big Four. Although that being said, Big Four is also drawing down their pre-sales as well for the right project in the right areas with developers that they believe in. Good projects will always attract capital, and more marginal projects will always attract capital at much higher rates. But to an earlier point that you made as well, what I am seeing is a little bit of a shift, because my investors tend to be private capital, private families. I do have some insto investors as well, but I'm seeing a shift from where they were plowing a lot of their capital into debt, back into equity. Back into direct. They want to be part of the equity stack as well. And part of that is because the returns are no longer there in the private debt that were there, or the returns for the risk that you're taking. They're like, well, I'd rather actually get a higher return back for good projects, and I'm happy to go in the equity.
And what about preferred equity, a pref-ec position in the stack then? Are we talking, when it's a return to equity, is it sitting in various positions in your mind?
Absolutely. Yeah. So I actually believe that, when I look at the full capital stack, senior, mezz debt, pref equity, and equity, all are still alive and well, right? And so It really depends on the deal as to where that capital wants to go, and a lot of the private groups and private families are actually quite sophisticated in their understanding. So I'd say over the last kind of 10-year journey, let's say, where they had capital and they're like, I'll just deploy it, they have become much more educated in the mezz and the pref and the proper equity, as to what that means in the stack, what that gives them in the stack, and the returns that they can expect for that.
Yeah, and I think that's been probably a big shift in the last decade as well that we've seen with private capital as well, right? The knowledge base around it has shifted significantly because of the volume of opportunity. If I'm going to sort of try and say where I think 2026 is going to be, I'll ask you about the equity position, but my view for 2026 is going to be there's return and favoring those high quality fundamentals, as well as that alternatives and in particular living sectors space is where we're going to see it.
Yeah.
What's your call?
I would be right on there with you. I think alternatives are growing. So interesting, because what capital is looking to invest in is great operating platforms. So if you're trying to attract international capital, build a great operating platform.
So if you're saying that the future is about operating platforms as part of the prop co, then they're not necessarily going to be tied to the changes that we've seen in the rates over the last few years, and that's where value comes from.
Absolutely.